One of the most powerful tools we have access to in securing our financial future is the RRSP. Whether you're a seasoned investor or just starting out, I've got some really exciting news for you. You want to hold on to your hats because 2025 brings us an amazing update when it comes to the RRSP contribution limit, in that it has gone up to now a whopping $32,490. That's up $930 from last year, giving us even more room to stash away our hard earned dollars in a tax efficient manner. This is a very important update because this means you can shield away a larger chunk of your income from immediate taxes and set it aside for long term wealth building. Especially in today's world with economics ups and downs that we're going to face inevitably, this update recognizes how crucial it is to build retirement savings, how important it is to make sure you've stashed away your nest egg in a tax efficient manner. And for many Canadians, this update is going to translate into stronger financial security. So when it's time to sit back, relax in your golden years, you have access to that much needed income. All right, let's move on to another key tool for Canadians that I'm a big fan of, and that is the tax free savings account, the TFSA. You want to think of your TFSA like a financial playground the government has given you to invest and save for the future so long as you're at least 18 years or older. And unlike the RSP, there is no immediate tax break for contributing towards the TFSA. But the real magic in a TFSA is what happens inside the account once you put your money in. Any money you put inside your TFSA will grow completely tax free. That means when it's time to take money out, you won't have to pay a single cent to the tax man. How beautiful is that? And I'm a big fan of the TFSA just for its sheer ability to completely shield you away from taxes. It's like the closest thing to having your cake and eating it too, because a tax man definitely can't take a bite out of this beautiful cake. And this is what makes the TFSA such an incredible, powerful tool, whether it's your long term savings, whether it's short term savings, or anything in between, because you can rest assured any money that's growing inside this TFSA, there are zero tax implications. Small caveat, when I say zero tax implications, as long as you're staying away from day trading, you're pretty much in the green zone. And for 2025, the contribution room has gone up by $7,000. That's an extra fresh $7,000. You can grow your wealth completely tax free. And as you can see in this chart, each year, this limit is adjusted for inflation, ensuring that you always have ample opportunity to grow your savings and investments on a completely tax free basis. And here's a quick little nugget of history. If you had opened a TFSA since it was introduced back in 2009, by now, by 2025, that means you have a lifetime cumulative balance of $102,000 that you can invest, grow completely tax free. So I really hope for 2025, this is on your list of your financial goals to invest and use your TFSA. And if you don't know how to use your TFSA or what stocks and what ETFs to put into your TFSA so you can take advantage of this tax free growth, I will leave links in the description below so you can check out what I use my TFSA for. Imagine finally stepping into your dream home, all thanks to a tool called the First Home Savings Account, the FHSA. This was introduced back in 2023, and it was designed to help Canadians make home ownership just a little bit more accessible with a lot of tax advantages. Think of this like your financial ally. It combines best of the RSP, best of the TFSA into one neat little package. And I'm going to tell you in a little bit of a secret here, the magic formula that really makes the FHSA really shine. You get tax deductible contributions that lower your taxable income. And that's on top of the tax-free growth and withdrawals, which is the perfect combination to maximize your savings on a tax-free basis. You should definitely be taking advantage of an FHSA in 2025. And for this year, you gain an extra $8,000 of fresh contribution. Again, you will get a tax deduction for putting money inside the FHSA, and when you withdraw, it's tax-free. Keep in mind, there is a lifetime contribution limit of $40,000. So all you have to do is make sure you contribute to your FHSA and give it plenty of time to grow, and you're going to be growing your down payment on a tax-free basis when it comes to taking that money out for that first home. And when it comes to eligibility on how to open up an FHSA, it's fairly straightforward. You have to be a Canadian resident. You have to be at least 18 years old and you have to be a first home buyer. What that means is that you have not owned a home in the last 5 years. So this ensures a wide range of Canadians can take advantage of the FHSA. And remember the best part, you get a tax break upfront for contributing to the FHSA, and the tax and the withdrawals that you make from your FHSA are tax free so long as you use the proceeds to buy your first home. So that means if you use your FHSA correctly, every dollar you put in and you're able to grow on a tax free basis, it's going to get you that much closer to making your dream home a reality. Again, just like the TFSA, if you are not sure of what stocks and ETFs to put inside the FHSA, make sure to check out the link in the description below, where I got videos for you on how to optimize and maximize your FHSA, how to maximize your TFSA, and how to maximize your RRSP. So make sure to check out all the links in the description below. CPP. Some people love it, some people hate it, or some people fall in between. Let me know in the comments where you stand when it comes to the CPP. But for 2025, I have some very important updates that you definitely want to pay attention to. The best way to think about the CPP is that it's your financial safety net when it comes to your retirement years. And in 2025, there's important updates towards the basic CPP and CPP 2.0, and I'm going to break that down for you in just a little bit. When it comes to the enhancements of the CPP 2.0, the whole point is that it's supposed to provide Canadians with a stronger source of retirement income when they get to their golden years. Yes, the contributions are going up, but the point is that it really underlines the importance of contributing towards the CPP so you have access to more income when you need it the most in your retirement. And yes, I've heard from you in the comments, in your messages and emails, etc., DMs. The CPP is a form of forced savings, whether you like it or not. But understanding these adjustments will at least help you budget for a successful 2025, knowing what's in store every time you get paid. Let me just break down all those details for you. That's going to seem like a lot of information, but let me break it down for you on what you need to know. The first up is the contribution rate, which is 5.95%, and that is unchanged since 2024. And if you are self-employed, you have to double up that contribution rate because you are paying the employees 5.95% and the employers 5.95%. So everything for self-employed individuals is double when it comes to the CPP. Now, with that said, if you are an employee contributing towards the CPP, the maximum you're going to contribute in 2025 from your paycheck is now over $4,000 at $4,034, which is up close to $167 from your paycheck from 2024. And again, if you're self-employed, just double those amounts. And CPP 2.0, you're going to contribute an extra 4% of your paycheck on earnings between $71,300 up to $81,200. The percentage remains the same from last year, from 2024. However, the income has been adjusted. So what that boils down to is that when it comes to CPP 2.0, you're going to be paying $396 from your paycheck in 2025. That is up $208 from last year. To summarize it all, if you are making more than $81,200 in 2025, your total CPP contributions, the basic plus 2.0, is going to be $4,430. That is up almost $375 from last year. And if you look at the last line on this chart, you can see the full impact CPP plus CPP 2.0 for your self-employed business. Now, when it comes to your paycheck, not only do you pay CPP, but you also pay something called EI employment insurance. EI premium rate is down slightly, as you can see in the table, but the maximum earnings has risen. And what EI really does is that as long as you're employed, you're going to pay something called employment insurance. What it does is that in return to contributing towards this pot, you receive benefits if you lose your job, if you become sick, or if you have a baby that's part of that mat leave or pat leave program. So what that means for 2025, even though rate is down slightly from 2024, the maximum you're going to pay from your paycheck in 2025 is $1,077, which is up just under $30 from 2024. So to summarize between the CPP and EI, if you're making more than $81,200, you're going to be losing an extra $400 from your paycheck in 2025 versus last year between the EI and CPP. Now, all that may seem like bad news, so let's focus on some good news for a change. Imagine opening your first paycheck in 2025, and to your surprise, you actually have maybe a little bit more money to keep in your pocket. What does that mean? What that means in 2025, the tax brackets at the federal level have been adjusted to provide some economic relief because of the rise of cost of living and economic shifts. The way you want to think about these federal tax brackets is like a ladder. Every time you step up, it represents a range of your income that is taxed progressively higher. And as you climb up this ladder, only the income within each range is taxed at that bracket's rate. This keeps the system fair, and this is what's called a progressive tax system. The more you make, that higher income in that particular range is taxed at a higher rate. The common misconception when it comes to tax rates is that all of your income is taxed at the highest rate. That's not true. Only the income at that next bracket is taxed at the higher rate. So if you're making $100,000, not all of the $100,000 is going to be taxed at the highest rate. As you can see in the table below, some will be charged at the 20.5% rate, and the remaining will be charged at the 26% rate. So as you can see in these tables, specifically in this example of the Ontario and federal tax rates combined, tax rates generally remain steady. The income thresholds for each bracket have changed. This means a larger portion of your income will be taxed at lower rates compared to previous years. Essentially, this shift allows you to keep a little bit more of your money in your pocket versus going to a tax man. So let me know in the comments down below. You will have to pay more CPP. You will have to pay more EI, but you will get a little bit more breathing room because of these tax brackets. What are your thoughts on all these changes? I want to hear from you in the comments down below. There is one more relief that's on the way to hopefully make the CPP and EI increase a little bit more digestible, and that's called the basic personal amount. The BPA for short has risen to $16,129, meaning a greater portion of your income remains completely untaxed. So that means the first $16,129 you make is completely tax-free. This adjustment not only helps offset some of the burden of the CPP and EI, but coupled with the federal tax brackets, hopefully you can get a little bit of relief knowing that, yes, you have to pay more in CPP and EI, but at least you get a higher BPA and some relief from those tax bracket changes. So by understanding all these changes we're talking about, the goal is hopefully you can plan your finances better by knowing what's in store as opposed to you being surprised when you see that paycheck roll in. Earlier in the video, we talked about how using the FHSA can get you closer to that dream of owning your own home by saving up for a down payment on a tax-free basis. The second tax tool you can access is called the Home Buyers Plan, or the HBP for short. Coupled with the FHSA, add on the HBP, maybe that dream of owning your home is closer to reality with these updates we're talking about. So what's changed with the HBP? Well, technically the change was in 2024, but it still impacts 2025. Let me tell you why. So picture this, you're planning your finances, you're thinking about owning a home, and now it is April 16th, 2024. The government has announced that the maximum you can withdraw from your RRSP under the Home Buyers Plan, the HBP, has jumped from $35,000 to $60,000. But it doesn't just stop there. For couples, that means each person can withdraw up to $60,000 from the RRSP, effectively giving you $120,000 in the form of a down payment. Keep in mind, this doesn't include whatever you've saved from your FHSA. These changes reflect the reality of how difficult it is to save for a down payment. The government is giving you a few tools that can help you save up for that down payment, knowing how crazy high those real estate prices are. Now, there is one additional update to the HPP that's also very important, and it's the extended repayment grace period. So what that means is that previously the clock started ticking very quickly as soon as you withdrew from your HBP, meaning you had to begin repaying back to your own RSP by the second year of your withdrawal. What's changed is now that there is a 5-year grace period for withdrawals made specifically between Jan 1, 2022 and December 31st, 2025. So if owning your own home is in the horizon for 2025, you definitely want to consider the power of the FHSA and the adjustments to the HBP this year 100%. If you sell a capital asset like a stock or vacation home, the profit or loss from your sale becomes part of your taxable income, and this is called the capital gains inclusion rate. The 2024 federal budget did change the capital gains inclusion rate, meaning 2025 is the first full year this change will be in effect. And what really complicates matters is that this change is sort of caught in legislative limbo. So there's a chance maybe it doesn't happen or maybe it does, but at least I want you to know what is in store if it does go through. So take a look at this table and you can see the changes in the capital gains inclusion rate. So some investors I know may be trying to take advantage that before this change really takes into effect, that they're going to optimize their portfolio to take advantage of the lower inclusion rate. Some are going to assume that change does go into effect and they're going to plan accordingly, and some are going to assume that maybe when they change in government, this changes and it reverts back to what it was, but only one group can be right. But as long as you have the financial insights, you can make whatever decision makes sense for you. And I've done an entire video on how capital gains work in Canada when it comes to stocks, when it comes to selling any asset. I'm going to leave a link to that video in the description below. So 100% definitely check this out. If this change impacts you at all, you definitely want to watch that full video. Thank you so much for sticking with me in all these 2025 updates. Some are good, some are not so good, but I want to hear from you. How do these tax updates and changes impact your plans for 2025? Let me know in the comments down below. Let's start a conversation because there may be some tips and tricks that we can all benefit from by talking about these changes. My whole belief is that the more we talk about financial literacy, the more we can benefit as a group. Do me one quick favor before you close out this video. If you are happy about these 2025 tax changes, make sure you hit that like button. And if you're not happy about these 2025 tax changes, also hit that like button. And also, please don't forget to hit subscribe for future content. And also, check out all the links in the description below where I help you optimize your RRSP, what to put into your TFSA, what to put into your first home savings account, how capital gains work, how dividends are taxed. Lots of valuable information for you in the description. Make sure you check it out today. Make sure you reach out to me on askme.com and you will hear a response directly from me within 24 hours. That's it for now. I'll talk to you in the next one.